Good morning, everyone. Thank you for tuning into our latest broker webinar. If you're not already aware, Prestige was founded by brokers, and we keep them at the forefront of our business model. We're glad you could join us today for the first of many more webinars and informative events for our broker community. Kicking off the webinar this morning is Tim Kelly, Director of Sales and Business Development. Tim has been with Prestige for more than 17 years and has built incredible client and broker relationships. Also participating in this morning's webinar is Malcolm Slee, Principal at Groom Law Group. Malcolm advises on a comprehensive range of issues arising under ERISA, the Internal Revenue Code, and related laws and regulations as they relate to qualified retirement and welfare plans. Since the enactment of federal healthcare reform legislation in 2010, Malcolm has focused extensively on helping clients navigate the new statutory rules guiding the continued operation of their health plans and insurance effectively under the federal regulation. Here's a look at today's agenda. We want to maximize our time together and spend as much time on the theme, the Affordable Care Act, so all participants are muted during the presentation. But we welcome questions. If you have any, feel free to type them in the chat area. We'll address all questions at the end. If we do not get to your question, we'll reach out to you directly after the presentation. Today's presentation will be posted on our broker page. So without further ado, I'll turn it over to Tim Kelly.
Thank you, Shannon, and welcome to several of our current and all of our future broker partners. We appreciate your time and attendance today. Before we get started, I just wanted to give a brief overview of Prestige. For those of you that don't know us and have not had the opportunity to partner with us, just a few words about Prestige. We've been in business 23 years, but I think what's most important to our broker partners is that we are brokers ourselves. We were founded by brokers and employee benefits experts. And what that means is we've developed a PEO from the ground up that's dedicated to serving as a broker channel partner. And you'll see by some of the things we share, a lot of the decisions that we make and the actions that we take and how we conduct our business all come back to supporting that relationship. We happen to be a local presence with a national reach, and we're constantly expanding into new markets. We currently have offices in New York, New Jersey, Raleigh-Durham, North Carolina, as well as Tampa and Sunrise, Florida, with expansion plans into at least two more organic markets this year, as well as an acquisition strategy that has helped us to expand our footprint. We're consistently delivering a client retention of about 95%, which is really great in our industry. And when we talk about the industry, there's approximately 500 PEOs. In size, we rank about 13th. But what's most important to our broker partners and their clients is that we rank among the top 1% of all PEOs in terms of the accreditations that we hold, which lets you know and the client know that we adhere to the highest financial and service standards in the industry. So we have an IRS certified PEO designation. We maintain the Employer Services Assurance Corporation designation, often likened to the FDIC of the service industry. We also maintain a workers' comp risk management accreditation. What's most important about that is we obtain those accreditations across every one of our operating companies. So every client company that qualifies is covered by those protections, and that's not true of all of the PEOs in the market. Obviously, we're very active in the National Association of PEO organizations. We've been members since '98, and our partners and executive committees have served all the way from chairman through board positions. It's the leading association for PEOs. It's really the cutting edge of what's happening in the industry, and we're active participants, so our brokers and clients obviously benefit from that participation. We're very proud also to be endorsed by the American Institute of Certified Public Accountants. We feel this is very important because we're typically dealing with small and medium-sized businesses, and the accountants play a significant decision-making role in those relationships. So in addition to partnering with industry experts like Malcolm, who's going to be speaking to us and educating us all, about the ACA, we provide support on a day-to-day basis for our client companies. So we handle reporting of the 1095-C forms to all eligible employees. We provide that to clients that are with us for a full year. So we'll provide information for partial years, but actually do the reporting for full calendar years. We're also instrumental in helping clients to determine if they're considered an applicable large employer under ACA by tracking the hours worked by all employees. And we provide general guidance on the ACA as well as applicability. Many times, brokers and clients are telling us that they have to go outside and pay additional costs for these services, something that we provide as part of our service. Real quickly, and I'm not going to touch on all the bullets, but here's the top 10 questions we often get asked by brokers in terms of why they might want to consider partnering with an organization like Prestige. We spoke a little bit about who you're dealing with and what our background is like. Big question is about accepting broker record letters, and we never do. We protect our broker's commissions for the lifetime of the client. We would actually walk away from a case before we would give her a broker record letter, which we've never had to do. Brokers are very interested in how to win new business all the time, so we utilize our market differentiation in the PEO industry, our extreme flexibility to be able to carve out insurances as well as workers' compensation, our ability to address specialty markets. We've got a very popular FinServe program designed specifically for financial services and a tech vertical. So those are all areas that assist our brokers in obtaining access to new business. Of course, brokers are always concerned about how their clients are going to be taken care of. One of the biggest distinctions that we provide is our customer service model, where we provide a hands-on boutique-style service delivery, much like the broker partners we engage with deliver to their clients. The employer, the employees, the employee's dependents, as well as the broker, have access to our dedicated service team. There is no 800 number or chatbots for service. We're asked how we help clients. Well, we help clients grow and grow more profitably. Statistics from the most recent survey put out by the National Association of PEO shows that companies that partner with a PEO grow 10% more quickly than non-PEO clients. They also have lower turnover, which equates to increased profitability, and they're 50% less likely to go out of business, which means that our brokers are keeping their clients longer. And we all know that when clients grow and we keep them for a longer period of time, that commissions grow as well. Client retention is often a big question. You see it a lot. We have a 95% client retention in our 23-year history. And we also have an average client engagement of 8 years. The PEO business tends to be very sticky because we're touching on many facets. So while we handle many things and become valuable to the client, it's a very strong relationship. How do we help brokerages and brokers become more profitable? Well, by allowing you to utilize that team of experts and providing service to the clients and the employees, what our brokers tell us is it allows them to scale their businesses more easily. Some of the day-to-day that they were normally handling is transitioned over to our experts. They don't have to add any additional internal headcount. And on top of that, the length of engagement that we have with those clients allows brokers to keep clients longer. The clients are growing, and there's commissions maybe on more lines. So we talk about client referrals as well as commissions below. All client referrals are directed back to the original broker. Whether you're actively working with that client or have not talked to them in a while, anything that we generate internally from a client referral is tied directly back to the original broker, part of our commitment to the channel partner. Commissions, we're paying typically higher commissions on more lines of coverage and for a longer period of time, which equates to more client profit over time. How does our partnership work? The business development managers that work with brokers and clients from the get-go are tied to that case for the lifetime, just like the originating broker. We don't have a direct sales force that competes with brokers for business. All of our business is tied to a broker, even if we get call-in solicitations. The sales rep tied to the life of the case means they have a vested interest, obviously, in client satisfaction, client retention, and growth. So that's been a very successful formula for us. We very much appreciate the brokers helping us to grow our business at a significant rate with some of the highest client satisfaction and retention in the industry. If you'd like to learn more about how we work with brokers, happy to discuss after the webinar. Please submit any questions in the chat. I'm going to turn it over to Malcolm right now. And of course, any questions about the topics Malcolm is covering, please send in the chat, and we'll try to address all of them by the end of the session. Thanks very much.
Great, thank you, Tim. And thanks to all of you for logging on this morning. Appreciate your time, and thanks to our friends at Prestige for having me on today. So the plan for this morning is I'm gonna do sort of a refresher on the employer mandate rules and the ACA tax reporting rules that are related to the employer mandate that apply to applicable large employers. We'll talk a little bit about the IRS penalty process, what can trigger an IRS penalty, what to do if you get a penalty notice, and we'll talk a little bit about sort of what's changed over the last year or so. So again, diving right in here with a little recap in terms of the employer mandate rule. As folks on the call probably know, the employer mandate is, or as the IRS prefers to refer to it, the employer shared responsibility rules. They've been in effect now since 2015, which is sort of unbelievable to me. You know, we're in the middle of, I guess, our 8th year of having to deal with these. To confirm, these only apply to what the IRS refers to as applicable large employers, which are generally employers with 50 or more full-time employees. As Tim indicated, Prestige is certainly capable of helping you understand whether or not you are an applicable large employer if you're close to that 50 employee threshold. But today's presentation is really geared to employers with more than 50 full-time employees that are subject to the mandate and subject to the related reporting rules. So in order to understand the mandate, there are a number of different concepts you have to understand as well. And in particular, it's helpful to know how these concepts work in conjunction with each other. On this particular slide, I'm going to highlight 3 of the most important ones: offer of coverage, affordability, and minimum value. So the employer mandate is designed not just to require employers to provide coverage, but to also require employers to provide coverage that is meaningful to employees. Otherwise, obviously, employers would just provide coverage or they could provide coverage that was so minimal that employees wouldn't really be able to utilize it. Or the flip side of that, employers could provide coverage and it could be so expensive that employees couldn't afford it, and therefore they wouldn't be able to use it. So under either of those scenarios, employer-sponsored coverage wouldn't address the problem that the ACA was originally designed to address, which was underinsurance of individuals. So you'll see here on this slide, at the very top, it says employers must offer medical coverage that meets certain standards to full-time employees and their dependent children up to age 26. You'll see there the word offer is highlighted. Remember that an employer, even if you've got the coverage in place, the employer is not treated as having made an offer of coverage to an employee for the plan year if that employee is not given an effective opportunity to actually elect or to enroll in that coverage at least once during the plan year, or if they're not given an opportunity to decline to enroll if the coverage wasn't considered to meet the minimum value standards or was considered unaffordable. So essentially, you know, keep that in mind. The offer of coverage itself is very important. That term there, minimum essential coverage, the coverage that's offered has to meet some minimum standards, which is defined by the government as minimum essential coverage. Most people, when they see minimum essential coverage, they think, well, that must mean there must be some sort of minimum level of health benefits provided. It really doesn't. minimum essential coverage is defined in the ACA in terms of the source of the coverage. And so basically, any coverage under an employer-sponsored plan is going to meet that minimum essential coverage requirement. In order to satisfy the employer mandate and avoid penalties, as we get down into those crucial concepts there, the coverage has to be affordable. Otherwise, an employee might get a better deal by going and purchasing individual coverage from one of the ACA exchanges. And so the IRS defines the affordability based on on whether or not the employee contributions for self-only coverage, what percentage of the employee's household income is needed in order to pay for that. When the ACA started out, that percentage was 9.5%. You will see very important there, it has increased over time and is now 9.61% for 2022. The reason for that is that the way the statute is set up is the percentage threshold is tied to the affordability percentage for purposes of eligibility for premium tax credits under the ACA. And there is a statutory mechanism for that generally adjusting over time. What's interesting for 2022 is that, so the threshold started out at, it was originally in the ACA at 9.5%. In the very first year, when you applied the statutory adjustment, it went up to 9.56%. And then it sort of slowly, generally went up over time. For 2022, it actually went down from 9.83% to 9.61%, which is not a big deal, not a huge change, right? But a little bit of a disturbing trend in that to the extent the threshold is going down, that actually creates exposure for employers because the lower that threshold is, the harder it is to meet the affordability standard. And as we're going to discuss on slides coming up, if your coverage you're offering is not affordable, that's what potentially exposes you to ACA penalties. So for 2022, the affordability threshold is at 9.61%. That threshold will change over time. Typically, by the end of the year, they're going to announce whether or not it's going up or not. So you want to keep an eye on that with regard to the threshold. In order to make sure that you are meeting those affordability standards, the IRS came up with 3 safe harbors that employers can use to assess affordability. One is based on whether or not the affordability is essentially if the employee premium share for self-only coverage doesn't exceed 9.61% of the amount that's reported in the employee's box 1 of their Form W-2 every year. You'll see there, the second bullet under there, the sub-bullet there refers to the employee's monthly wages. That's referred to by the IRS as the rate of pay safe harbor. That's met if the employee premium share for self-coverage doesn't exceed effectively 9.61% of the employee's hourly or monthly rate of pay. And then lastly, there's federal poverty safe harbor, which is met if the premium share for self-only coverage doesn't exceed 9.61% of what would be the federal poverty line for one person. And then the last thing the last concept I want to touch on here is what we refer to as minimum value. So this is really where the coverage has to effectively meet some sort of minimum standards in order for you to avoid the penalties. The ACA provides that an employer plan wouldn't be providing minimum value if the plan's share of the total cost of benefits provided under the plan is less than 60% of such costs. So basically, if the plan is not picking up a sufficient percentage of the costs. I believe all of the plans that are offered through Prestige are going to meet that minimum value standard. So there are 2 potential penalties that can apply under the ACA, and I'm going to refer to them during this presentation as the A penalty and the B penalty. The A penalty is sometimes referred to as the nuclear penalty. It's the much more significant penalty that can apply under the employer mandate. And that's the penalty that can apply if essentially you are not offering coverage to a sufficient percentage of your full-time employees at all. So if you were an employer and you didn't offer health coverage, or you weren't covering enough of your full-time employees, you could be hit with that A penalty, which can be pretty significant. The B penalty is a penalty that applies on an employee-by-employee basis. And essentially, even if you are providing coverage to a sufficient percentage of your full-time employees, you can get assessed a B penalty if you do happen to have a particular full-time employee who's not getting coverage and who qualifies for a premium tax credit from the government, and your coverage didn't meet the minimum value and affordability standards. So I'm just going to walk through we've got a little flow chart on this slide and sort of walk through it here. If we start in the top left-hand corner, that very first question, do you offer minimum essential coverage to at least 95% of full-time employees? That's really the most critical test with regard to the employer mandate. You want to be offering at least some sort of employer-sponsored coverage to at least 95% of your full-time employees. Because if the answer to that is no, going to the right there, you'll see that you're exposed to that A penalty. Now, in the slides that are coming up, we'll get to it, but when we get to the next few slides, I'll have some examples. But the A penalty is can be much more significant because it is, you'll see there, the penalty there is $2,750 for each full-time employee. That's on an annual basis, but it's multiplied by the number of full-time employees that you have, subtracting out 30. So it can add up because it's going to look at your entire full-time employee population, regardless of, even if you offer your coverage to 94% of your full-time employees, you don't get a break by the fact that you just barely missed that 95% threshold. If you don't hit the 95% threshold, you can end up with the A penalty essentially on almost your entire full-time employee count. Now, let's say you did offer minimum essential coverage to at least 95% of your full-time employees. So again, going back to that top left-hand corner, we would now go down on the flow chart to yes. Does your plan provide minimum value? Again, picking up at least 60% of the costs. And if the answer to that is yes, then the next question is the coverage affordable? Are you meeting one of those affordability safe harbors that I talked about on the last plan, where essentially employees are not coming out of pocket for more than 9.61% of the cost of coverage? If the answer to that is yes, you are in the clear. There's no potential penalty. But if you answered no to either of those last two questions about the plan providing minimum value or whether or not it is affordable, you at least have some potential exposure to the B penalty. Again, this is a penalty that is applied on an employee-by-employee basis. So if your plan doesn't, for a particular employee, if it doesn't provide minimum value or it isn't affordable, and the employee didn't enroll in the coverage, and the employee instead went to one of the ACA exchanges and bought individual coverage and qualified for a premium tax credit, and the IRS finds out about that, they will assess you one of these B penalties to effectively make you, pay a penalty for the fact that the person is getting subsidized coverage through the ACA exchange because the coverage you offered them, the employer-sponsored coverage that you offered them, wasn't good enough. And you'll see there the B penalty is on an annual basis, works out to $4,120 per full-time employee. That amount, the $4,120 for the B penalty and the $2,750 for the A penalty, those amounts Again, those are the 2022 amounts. They go up every year. Originally in the ACA, when it passed, those penalty amounts were $2,000 and $3,000 respectively. They are adjusted for inflation every year, and given what inflation is doing currently, it might be a little frightening to see what the penalties are going to be like for 2023. They're certainly going to go up again. Well, I've got a couple of examples on these next few slides, which will hopefully give you some sense of the scope of these potential penalties. So here's a very simple example for how the A penalty can apply. With our hypothetical company, Acme Company, let's say they had 125 full-time employees in each calendar year of 2022. And again, we're keeping it simple here. They just simply didn't offer any employer-sponsored health coverage in 2022. And in that third bullet there, it says Acme receives a Section 1411 certification for 2022 with respect to at least one of its full-time employees. Now that's a little bit of IRS jargon, but what it essentially means is a Section 1411 certification is essentially a certification that at least one of its full-time employees qualified for a premium tax credit from the federal government. It only has to be one. You know, they've got 125 full-time employees. If just one of those full-time employees qualifies for the premium tax credit because they went and bought individual coverage through the ACA exchange, that is going to trigger an A penalty. And you'll see here the calculation. Their Acme's A penalty for 2022 is going to be about $261,000. So we determined that by looking at what the annual penalty amount is for the A penalty for 2022. It's $2,750, as we mentioned from the last slide. We then take Acme's 125 full-time employees. The IRS cuts you a little break. They say you can subtract out 30 of those people for the purposes of figuring out the penalty. And so that leaves us with 95, and we multiply those two numbers together, and that's how we get the $261,000. And that's that is a sizable penalty, and we've certainly helped clients try and deal with these types of penalties when they get assessed by the IRS. For an employer with 125 employees, $260,000 is a considerable chunk of change, and you can see certainly. If Acme had 500 employees, we would be in the range of about $1 million for this penalty. So it certainly can add up depending on the size of the employee. And again, in this example, Acme didn't offer any coverage. Keep in mind, though, as long as if they needed to offer coverage to at least 95% of their full-time employees. If they're under that number, if they offered coverage to only 94% of full-time employees, they still have this very significant exposure. So that 95% threshold is absolutely critical. Okay, now we can move on to B penalty example. And for this one, again, the B penalty is assessed on an employee by employee basis. So in 2022, let's say Acme actually offered coverage to 98% of its full-time employees. So it got over that 95% threshold. It doesn't have A penalty exposure. But for whatever reason, they didn't offer coverage to Frank, who happened to be a full-time employee for all of 2022. Frank went to one of the ACA exchanges. He purchased individual coverage. He was eligible to receive a premium tax credit for 5 months in 2022. And then Acme gets one of those certifications from the IRS with respect to Frank that he actually qualified for the premium tax credit. So in terms of determining Acme's penalty for 2022, we start there with that number $343.33. Now I mentioned that the annual penalty for the B penalty was based on $4,120. That $343 amount is the monthly amount. So if you divide 4,120 by 12, that's what you come up with, $343 per month. Then Frank, as I mentioned, he only got the premium tax credit for 5 months during the year. So we are just going to simply multiply that $343 by the 5 months. And so the penalty for Frank is about $1,716.67. Much more manageable relative to the A penalty, right? Where on the A penalty, we were talking about hundreds of thousands of dollars. The B penalty, since it's done on an employee by employee basis, tends to be much less. Here, we've got a couple of $1,000s, which is going to be more manageable. And so I like to point that out because even though the annual penalty amount is greater for the B penalty, in practice, the A penalty, the magnitude of the A penalties is generally much more significant. And I would say, in our experience over the last 8 years or so, most of the employers we work with, quite correctly, are very focused on making sure they're offering coverage to most of their full-time employees, getting over that 95% threshold, making sure that they have cabined off any potential exposure for the A penalty. But generally, even the most compliant employers, there will be employees that slip through the cracks. Typically, one thing we see a lot is an employer just fails to identify that somebody is considered a full-time employee under the ACA rules. Maybe they've got them coded incorrectly in their system as a part-time employee when the person has actually been working full-time hours, and they don't realize it till the end of the year that they should have offered that person coverage and they didn't. So a lot of times I think of the folks that end up triggering the B penalty assessments kind of slip through the cracks. And again, there's always going to be some issue for employers. It's tough to eliminate the B penalty exposure entirely. You have to be extremely diligent in terms of record keeping, and there may be, as you go through time, employers may occasionally have to deal with these B penalties, but they're a lot easier to deal with than the A penalties, which can be so significant. So that was the end of the employer mandate recap. Now I'm going to talk a little bit about the employer mandate, or the ACA tax reporting requirements, and you'll see at the top of the slide, it says 6056 reporting basics. IRS, our Internal Revenue Code, section 6056, is where all these reporting requirements are located. So we refer to them sometimes as shorthand as 6056 reporting. This is really all of the reporting that is applicable to large employers that are subject to the employer mandate requirement. So what employer mandate reporting really requires is that each applicable large employer member has to file a return with the IRS after the close of each year, and they have to issue annual statements to all of their full-time employees about the coverage, if any, that was offered to the employee by month. It's got to include the lowest employee cost for the self-only coverage offered. And as noted there, you've got to report it for any employee who was full-time for at least 1 month in the year. And there's really 3 purposes to this reporting. One purpose is to give the IRS the information the IRS needs in order to enforce whether or not an employer is actually complying with the employer mandate provisions of the ACA. And we'll get into more detail on that as we continue through the presentation, since that's really our focus today. But the other purposes, so the second purpose is it helps the IRS determine if an individual was actually eligible for those federal premium tax credits or cost sharing reductions, because an individual's eligibility for those tax subsidies is affected by whether or not they actually had access to employer-sponsored coverage. If they actually had access to employer-sponsored coverage, and again, that coverage met the affordability and minimum value requirements, then generally employers are not going to be eligible for those federal tax subsidies. And then the third purpose is the statement that the employee actually receives helps that employee understand whether or not he or she may be eligible for the premium tax credit when they're filling out their federal tax return for the year. Again, if the employer provided health coverage, it didn't provide minimum value, or it wasn't considered affordable, and that employee had purchased individual health insurance on an exchange during the year, that employee might be eligible for the premium tax credit. It depends on a number of factors, including the employee's income for the year. So those are really the three purposes of this reporting requirement. The forms, there's the 1094C, which is a transmittal form that provides information about the employer that's actually providing the form. And so each employer has to complete a 1094C and file it with the IRS. And then they have to complete a separate 1095C for each full-time employee during the previous calendar year. Those forms are generally due on March 31st of each year. If you're filing electronically, which most employers do, they actually are due earlier if you file with the IRS by just mailing in paper forms. There are ways of obtaining extensions, but if you don't obtain an extension, that March 31st date is very important. If you miss it, you are potentially on the hook for penalties, so you want to take that deadline very seriously. And then there is a separate requirement just as important, which is the requirement that you actually furnish your full-time employees with a copy of the 1095C. Again, they need that in order to, or they may need that in order to fill out their federal tax return. Originally, in the ACA, the requirement was that 1095C had to be provided to full-time employees on January 31st, which, as many of you work with employers know, that's the date that employers also have to get out their Form W-2s to employees. The IRS, that was always a very difficult deadline for employers to meet, that January 31st deadline with regard to the 1095C, because, excuse me, it was often difficult to obtain all the information regarding the health coverage that was provided during the prior year and get all that information compiled and get the forms completed all within the month of January. The IRS is effectively, in regulatory guidance, just come out with a blanket rule that now you have to furnish the 1095Cs 30 days following January 31st. Of course, if February is a leap year, then it gets complicated, but that deadline is typically March 2nd of every year. So very critical here, one thing I want to highlight again, and this was sort of the what I'm referred to on the prior slide as the first purpose of the 1094 and 1095C reporting. This reporting is, you're effectively in many ways telling upon yourself or turning yourself into the IRS. The IRS systems are going to be set up in a way that they look at this reporting and utilize it to determine whether or not the employer could be subject to an ACA employer mandate penalty. And so what I've got on this slide is an actual screenshot of the Form 1094C, which again is the transmittal form that employers have to submit every year to the IRS, with effectively sort of summarizes information about their employer population and the coverage that they provided. And I'm sure folks on the call, have been dealing with these reporting requirements over the last few years are probably very familiar with this form. Where that arrow is pointing to, I realize it may be a little hard to see if the slide is small on your screen, but that is a indicator on the Form 1094C where you effectively tell the IRS whether or not you offered coverage in each month of the year to at least 95% of your full-time employees. And you either check the box on the left that says yes, or you check the box on the right that says no. Very important that when completing the 1095Cs, if you check the box that says no, in any particular month you did not offer coverage to at least 95% of your full-time employees, you are effectively communicating to the IRS that you may be on the hook for an A penalty for that month, which again, we could be talking about hundreds of thousands of dollars or even millions of dollars in exposure. So that is a really very important part of the 1094C, and you always want to make sure that it is filled out correctly. Similarly, this is a screenshot of the Form 1095C. And again, you're going to file one of these for each of your full-time employees, and every full-time employee is going to receive one of these. And again, these forms have been around for a while, so I'm assuming probably most people, this is not the first time they've seen this. You'll see on this form, this is the part of the 1095C Part 2, where you communicate to the employee and the IRS whether you actually offered coverage to the employee for that month and the cost of that coverage, whether or not it was affordable or not, and whether or not one of the affordability safe harbors were met if the person actually didn't enroll in the coverage. So again, this is in many ways a mechanism for you to tell on yourself, or for the employer to tell on itself to the IRS. The IRS systems are set up in a way where they will read the information that you provide to them and the codes that need to be entered in here. And if they see that in any particular month, you either didn't offer the person coverage, or you offered them coverage and it didn't meet the affordability or minimum value standards, and the IRS obviously has systems that track whether or not people are claiming premium tax credits for any particular month. So if the information on this form doesn't, has a mismatch with the IRS's information regarding whether somebody actually got a premium tax credit in that month, that is going to potentially trigger a penalty. And that is what is going to lead an employer to get a letter from the IRS saying that they owe them a B penalty. Yes, and this is where the process begins. We certainly have clients that have gotten these letters. I'm sure brokers out there have had to deal with clients who've gotten these letters and tried to work their ways through it. It is referred to as a letter 226J, and essentially this is sort of a preliminary notice from the employer that they have determined that the employer may be on the hook for an employer mandate penalty. As noted there, it is not a formal notice and demand for payment, but it contains a lot of information that basically communicates to the employer that the IRS thinks, based on the records that were provided to it, that the employer may be on the hook for a employer mandate penalty, either an A penalty or a B penalty. So if you've seen one of these 226J letters, there's a table in the letter that itemizes all the payments for the month and identifies the employees and indicates, whether it's a penalty or a B penalty. There is a form for the employer to respond, a list of all the employees that triggered the employer's assessment. There is a notification in there, which is extremely important. We're telling the employer that they have 30 days to respond to the letter 226J. We strongly recommend to employers that they are keeping to that 30-day deadline. It's possible to get extensions from the IRS. I will tell you, anyone who has had to deal with the IRS, particularly over the last couple of years, will tell you it can be very challenging to even get a human being on the telephone. And there's the 226J has contact information like a phone number, but there is no guarantee you're actually going to be able to talk to a human who is going to grant you a 30-day extension. So that 30-day deadline is incredibly important. And then a description of essentially the actions the IRS will take if the employer doesn't do anything with regard to the letter, which, as you can imagine, is likely going to be a formal assessment of the penalty. So if we move on. So if you disagree with the assessment, you have a couple of options. The first thing which we would absolutely recommend is that you respond by letter to the 226J, explaining why you think you are not subject to the penalty, assuming that you have a good argument for why you're not subject to the penalty. The IRS will then come back to you with what's referred to as a letter 227, There are 5 different letter 227, which sort of fall into different categories, like the IRS agrees with you and they're not going to assess a penalty, and you're happy and everything is done, and we've got a happy ending to the story. There are other 227s where the IRS disagrees with you. They think the penalty still applies, or maybe they agreed with part of your argument and they've reduced the penalty, but they still think some penalty applies. If you continue to disagree, if they're continuing to assess the penalty and you disagree with that assessment, you can request a pre-assessment conference, and then effectively you're going to have to go through the IRS appeals process to try and get your penalty reduced or abated. But note there on that final bullet, if you fail to respond within that 30-day period, you're not going to get a letter 227. You're just going to get assessed by the IRS. You're going to get a notice and demand for payment. That's on a separate form, the notice CP 220J. So again, responding within that initial 30-day period is critical if an employer or one of your clients gets one of those 226J letters. IRS reporting penalties. This is something that is really, I'm a little concerned about, just because it seems to have sort of heated up in recent months. Over the last few years, I'd say employers have generally been more concerned about getting the employer mandate penalties. They really need to be focusing on these potential penalties for failure to report correctly. And as noted there on the first bullet, you can get assessed a penalty for failure to actually file the 1095-C's forms, failure to furnish the 1095-C forms on time to your employees, missing a deadline, or if the information in the return is incomplete or incorrect. All of these things can trigger a penalty. The presumptive penalty amount is $280 per return. But again, when we're talking about employers with 100, 200, 500 employees, if they had sort of a widespread systems failure and didn't get the forms out on time or didn't file them on time, that amount can add up very quickly. Penalties are capped at around 3.4 million per year, but we have absolutely seen penalties assessed for employers in the millions of dollars with regard to reporting penalties. Again, largely depends on the size of the employer and the size of the failure, but these can get very, very significant very quickly. Double penalties can apply. So if you happen to just miss an employee entirely, and so that employee did not get a 1095-C and you failed to file the 1095-C with regard to that penalty, all of a sudden the penalty amount is not $280 for that person, it's $560 because you have 2 violations, one for furnishing, one for filing. And then that last bullet, important to note that penalties can be reduced though if you correct them within a certain time period. So if you, for example, correct the penalty within sort of 30 days, if you fail to furnish or file and you get that corrected within 30 days of the deadline, the penalties will be somewhat reduced. So important that if you discover a problem that you correct it as quickly as possible. And then this is also, I think, really, really significant, which was when the ACA reporting requirements went into place, those of us who were working with them back then, there was this massive confusion, entirely new reporting requirement, not intuitive, not simple, all these different codes and fields that need to be filled out. People were coming to the IRS saying, there's no way we're going to get this right. And so under the IRS rules, there are really 2 potential bases if you get assessed a penalty with regard to reporting for requesting an abatement. One of the bases is a reasonable cause standard, which is written into the Internal Revenue Code and regulations. This effectively allows you to try and get a penalty abated if you can show either significant mitigating factors with respect to the failure, or that the failure arose from events beyond your control, like your company's basement got flooded and all the files you needed in order to do the forms were destroyed. In order to qualify for the reasonable cause relief, you also have to demonstrate to the IRS you acted in a responsible manner, which generally means that you exercise reasonable care and also undertook steps to avoid or mitigate the failure. Generally, what the IRS has indicated is that if you want to use that reasonable cause defense, you need to be able to demonstrate that you corrected or tried to correct the failure as promptly as possible. So that is really the only basis that is currently out there if you get assessed by these penalties, is trying to successfully argue to the IRS that reasonable cause standard applies. Up through 2020, the IRS had provided an additional avenue for relief called good faith relief. And what the IRS essentially said was, okay, we understand these new reporting requirements are new and they're complicated. If you happen to do the filing or the furnishing and your form has inaccurate or incomplete information, as long as you can demonstrate to us that you tried to fill out the form to the best of your abilities and use good faith, we're not going to assess penalties. However, as I mentioned, the IRS has now confirmed that that good faith relief has gone away, no longer applies. It stopped applying after the 2020 filing year. And I think that is notable because for a few years there, we were not really seeing significant penalties assessed with regard to the ACA reporting requirements. In 2022, it is heated up. We've got more clients reaching out to us indicating that they have received notices from the IRS regarding penalties for ACA reporting. And we suspect that the IRS is taking sort of a tougher view on this now that the requirements have been in place for a while. And that in the past, it was probably easier to argue to the IRS that you shouldn't have been assessed with a penalty if there was just kind of a minor mistake or something happened that was out of your control. I think you've got to be more focused on making sure that you are meeting all these reporting requirements now, because it appears the IRS is not as flexible as they have been in years past. And moving on, I believe that is the end of my process. We got about 5 minutes till 11, so I will throw it back to Tim to see if we have any questions at this point.
So Malcolm, thank you for that. You've done an excellent job, and there are only a few questions, and I'm curious as to the answers myself. So the first question is, what should an employer do if they think they might be on the hook for the employer mandate penalty, or they indeed know that they didn't do the reporting correctly, but they haven't received any IRS notices?
Yeah, so I think you have to look at those two different scenarios sort of separately, right? So if an employer thinks, well, we maybe didn't offer coverage to a sufficient percentage of our employees, or we know, there was an employee we should have offered coverage to and we didn't, but we haven't actually gotten an employer mandate penalty assessment yet. My general recommendation would be, sit tight, because there really isn't anything you can do about it. You obviously can't get in a time machine, go back and offer coverage to somebody after the fact. And as I mentioned earlier in the presentation, you only really assess these penalties if an employee actually qualifies for a premium tax credit from the federal government. So it's possible you maybe just dodged a bullet and none of your employees qualify for those premium tax credits, in which case the fact that you might have missed your obligation with regard to the employer mandate really has no negative consequences for you. So in that scenario, I would generally recommend they sit back and, unfortunately, they're just going to have to sort of wait and see if the IRS catches them. With regard to the ACA reporting requirements, I think the key principle is if you find out you have a problem, whether you didn't file in time, or you missed a filing, or you didn't give a 1095-C to someone who should have gotten a 1095-C, you want to correct that as quickly as possible. Because again, as we sort of just talked about, really if you were going to make any sort of argument to the IRS that penalties shouldn't apply or that they should be reduced, one of the key things they're going to look at is whether or not you corrected the issue as soon as you found out about it. And you can, unlike offering somebody health coverage, doing an IRS filing or providing someone with an IRS form is something you can actually fix after the fact. So I think with regard to the reporting requirements, you want to try and get that corrected as quickly as possible. And again, you'll have to sort of hope the IRS doesn't come after you, but if you do, you've at least preserved a potential defense there.
Gotcha. Excellent. And then I guess dovetailing, people are asking what are the most common errors that you're seeing with your clientele or people that are seeking your guidance on the forms 94 and 95?
Yep. Yeah. So I will say, usually when people come to us, it's because they've actually gotten a letter from the IRS. So, at which point, you've got a problem when you got to call your lawyer. So I would say the biggest issue, particularly with regard to the employer mandate penalties, and this happens more often than you might think. And I had a slide on it earlier where I sort of highlighted on the 1094C that box regarding whether or not you offered coverage to at least 95% of your full-time employees. We've had a lot of scenarios where the employer just checked the wrong box there, told the IRS that they did not offer coverage to 95% of their full-time employees in a particular month, when in fact they did. It was just literally they checked the wrong box. And that is, again, you check the wrong box and the IRS computer sees that, it's going to likely trigger the A penalty. And thankfully, we've been successful in going back to the IRS and saying, this was just a total mistake of fact. This was just an error. We meant to check the other box, and the IRS has abated the penalties. But you can avoid yourself, a lot of hassle and legal fees if you make sure that box is checked correctly.
Excellent. Well, thank you very much, Malcolm. So I'd like to thank everybody for joining us today. We really appreciate the valuable information, Malcolm, that you've been able to share. And as Shannon mentioned at the top of the call, you can view this presentation on our website, on our broker spot there, prestigepeo.com/4-brokers. We welcome any questions that you may have in addition after the fact, and look forward to having you join us for future webinars on pertinent topics. Thank you very much, everybody.